The period 5 to 10 years before and after you retire is often called the retirement danger zone. There's a very good reason for this, and it's all down to one thing: sequence of returns risk. Today we're discussing why you need to prepare your portfolio for retirement, how to do it, and, just as importantly, how not to. So stick around. If you find topics like this helpful, take a moment to like and subscribe. Your support is very much appreciated. Okay, let's get started. In the accumulation phase during your working years, you ideally want a 100% equity portfolio to maximize returns. This is consistently the best performing portfolio over a 20 to 40 year period, even with a single global index fund. But, as you approach retirement, your investment objective shifts. As Wade Pfau noted, the goal is no longer to maximize risk-adjusted returns, but to ensure that basics will be covered in any market environment. It's not about chasing maximum growth anymore, but about making sure you can sustain your spending throughout retirement. Preparing your portfolio is crucial for several reasons. First, that sequence of returns risk I mentioned. This is the risk that the order of your returns dictates your outcome. If markets fall early in retirement while you're drawing from your portfolio, you lock in losses that your investments may never fully recover from. The answer isn't just to work longer and build a bigger pot. The smarter move is to choose an asset allocation that will mitigate the effects of sequence of returns risk in the first place and, importantly, helps you sleep at night. Second, let's be honest. If you're like me and you've picked up funds over the years, you probably have 20, 30, maybe more. It's like a garden left to run wild. Multiply this across your investment accounts, and you have an unmanageable mess and significant concentration risk. Pre-retirement is the time to sort this out and simplify. Finally, your risk tolerance decreases as you near retirement and continues decreasing as you age. This isn't surprising, as you become more reliant on your retirement savings. This is especially true in the UK, where the state pension provides one of the lowest income replacement rates among OECD countries at 54%, below the average of 61%. This brings us to when you should start. I'd suggest beginning around 5 years before your target retirement date, or even 10 years out if your risk tolerance is lower. This strikes a reasonable balance between avoiding sequence risk and not starting too early, like many target date funds do. This is the point where your focus shifts from growth to sustainability. So how does this work? There are a couple of decisions to make. First, determine your strategic retirement asset allocation. This depends on your risk tolerance and spending flexibility. Remember, this isn't just about de-risking. It's about spring cleaning and gradually aligning your whole portfolio to this new target. You could use a classic static allocation like 60-40 or 80-20, the conventional bucket strategy which structures your portfolio using time-based segments, or a rule-based dynamic allocation like a rising equity glide path. Second, decide on your funds. Importantly, keep equities and bonds in separate funds. That gives you control. If you hold a single balanced fund, or a fund of funds, like the HSBC Global Strategy range, you can't just sell bonds in a crash and leave your equities alone. The principles for fund selection are the same: diversification, low cost, and for bonds, sensible credit quality and duration. Importantly, I'd steer clear of high yield or junk bonds, which behave more like equities, and focus instead on short and intermediate term government and investment grade bonds. The funds I'd start with are the Vanguard FTSE All World, Vanguard Global Bond Index, and Vanguard Global Short-Term Bond Index funds. Third, direct new contributions toward your bond and cash allocation. It may not be enough on its own if you've been 100% equity, but it helps. If you're at your peak earnings in your late 50s or 60s, use that. Maximize your employer match and use salary sacrifice to boost contributions. Fourth, create a simple, time-based reallocation plan on a spreadsheet to move your existing funds. This should be a straightforward, linear reallocation from your current portfolio to your target. This mechanical, time-based plan removes emotion from the decision and aims to isolate you from the noise in the market. I recommend reallocating once or twice a year to keep things simple, focusing on stocks and shares, ISAs and pensions, where you don't face capital gains tax. Now, how not to do this? Don't leave it to the last year. That concentrates your risk and exposes you to a nasty bout of sequence risk at precisely the wrong time. Don't try to time it by waiting for market highs or pausing just because things feel a bit down. And don't move too far away from equities. You need equities to keep pace with inflation and manage longevity risk later on. One more point that may seem really obvious but many forget to do. When you map out your 5-year glide path, remember to factor in your new contributions. If those are going into bonds, your allocation will drift more quickly than you think. I want to end with a scenario that I haven't seen much discussed. What do you do in a bear market? You're midway through de-risking, and the market drops 30%. What then? Here's how I approach it. There are two parts: pause, then evaluate. First, I'd pause the de-risking during a major drawdown of 20–30% or more, because you're otherwise selling shares at depressed prices and locking in losses. Second, accept that a pause affects the plan and re-evaluate your financial readiness. If you're 3 to 5 years out, a short pause is usually manageable. If you're 1 to 2 years from retirement, it's tougher. Rerun your stress tests with the latest data. Remember, retirement is all about confidence. If the evidence doesn't give you confidence, then delaying retirement by a year or two is one of the most powerful levers you have. It avoids selling at lows, gives markets time to recover, and adds fresh contributions at cheaper prices. As researchers like Michael Kitzes have shown, shifting the retirement date even modestly can materially reduce this risk. On the personal front, this removes the psychological burden of retiring against the tide of data. If this video helped you, and you want to dive deeper into the essential steps before retiring, check out this video next. Don't forget to like, share, and subscribe for more content. Thank you for your support, and I'll see you in the next one.